George of the jungle, strong as he can be.
Hey George, I like all this textbook information about seller finance transactions, but hey, our market is changing and we might be dealing with some short sales. How would a seller finance transaction work for a buyer and a seller in that type of a scenario? Well, thanks for coming into thecreditjungle.com today. This is George Anderson, and if there wasn't a solution for this, we wouldn't be doing a video on it. So I'm just going to put out here one kind of a scenario, one possible way to solve this. There's a lot of different ways to skin the cat based on what the interest rate is on the seller, how much they have in arrears, type of loan they have, principal balance, fair market value, how much money does the buyer have down, what can the buyer afford for a payment. All these terms are flexible and are negotiated with a lot more liberal application on a seller finance than they would be if the buyer is trying to get a mortgage loan through a mortgage company or a bank. So let's just look at a situation here where we've got a seller. Fair market value on this house is $500,000, and right now they have about $480,000 owing, but $5,000 of that, they're a couple payments behind. So let's just say about $5,000 in arrears on here. But the good news is they have a 30-year fixed rate, 3.5% loan on there. And it really doesn't matter whether this is FHA, VA, or conventional. We can just say it's a conventional loan if you want on here. And they're maybe a year into it, 2 years into it. That is something that you need to know depending on how you structure the contract for deed on this side of the equation. So the seller has to produce their mortgage statement. And most of those terms should be right on there where it would help you with this. But they've got a principal and interest payment of $2,178. Now, that does not include mortgage insurance, taxes, and insurance on that. We're just going to deal with the constants right now of principal and interest here versus principal and interest over there. So what we're going to do to make this transaction work on here, we're going to have the buyer overpay for the home. Well, why would you do that if the seller is in a short sale position? Wouldn't you try to beat them down in sales price? And if the home's really only worth $500,000, why would you overpay for that? Well, if you're getting a mortgage loan and the appraisal comes in at $500,000, well, this isn't going to work because the 10% that the buyer has down, that $50,000, they're also going to need closing costs, which they can't get any help from the seller on their closing costs because the seller doesn't have the equity for it. But now they're going to also have to come in with the difference between the appraised value and the purchase price. Well, that's another $5,000. So an institutional loan on this one could cost the buyer an extra $10,000 out of pocket. And what does he get for that? Well, he's going to get about a 6% interest rate with mortgage insurance on it. Okay? So here's the benefit for the buyer. The buyer's going to come in here with their purchase price of $505, and then the $50,000 that they have allocated here is going to end up going to closing costs and title fees, for the title company and the real estate agents. But then there's another $20,000 here. So within that, we've got this $5,000 here that can it just depends on how you want to slice this up. This could we could call it going to the arrears, or we could put it into this commission bucket, whatever you want to do. But we end up with another $15,000 here. So the question is, what do we do with this money to be able to make the transaction work? Because we don't want to give it to the seller, because then the seller is getting equity that as though they had sold the house for $15,000 more. Well, the seller isn't going to walk away with any money from this transaction. So that $15,000, we need to have a contract balance here of at least $460 to make it work for the seller finance buyer on here. So what we do to make it work is we take the $15,000 here, and in addition to the $5,000 that went to the arrears to bring it down to $475, we're going to make another principal reduction on here so that the seller's balance on their loan at the start of the contract is equal to the buyer's contract down there. So we got $460 owing here, $460 owing there. Okay, so now we've kind of leveled things out a little bit, and that's going to be kind of part one of how to make the transaction work. Part two on this, I'm going to go into what's the benefit to the buyer, what's the benefit to the seller.